Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week of July 11th. We had a broad-based sell-off for most of the week with a decent little rally on Friday that ultimately put most of the major indices essentially back where they started on the week. So let's dive into the charts and see what we're taking a look at here. Starting out with the S&P 500, we've got multiple resistance points that we're going to need to see clear in this upcoming week before we'd really be much of a believer in any kind of bear market bounce. We need to get above this 390 level, which has been a support and resistance zone for quite some time. We also need to break this down channel trend line as well as the 50-day moving average. If we can get clear of all of those, then we might see a bit of a bear market bounce, and if that occurs, probably would potentially get back up to that 414.50 level before heading lower. But my bet, at least at this point, until we see some clear break above that, would be that we'll likely hit that 50-day moving average or one of these other resistance points before that, and probably head lower until we see that clear break above the 50-day, which hasn't happened since April of this year. I think the best probabilistic bet is that it's going to hit that level and head lower from there. Taking a look at the triple Qs, the Nasdaq, similar story. The only difference on this one is we are much faster approaching the 50-day moving average. I think we'll have some sort of resolution on that in the first few days of next week. If we do see a clear break above the 50-day moving average, then maybe we can get a bit of a bear market rally. If we do, I would think potentially the upside target on that might be 315. If we can get above that, then maybe we even get up to about 330 or so. But we definitely, just like with the S&P 500, we need to see a clear break above that 50-day before I'm going to be much of a believer in any kind of bounce. And so until we see that, I think the bias is to the downside, and we'll likely hit that 50-day and head lower. And similar story on the Dow Jones Industrial Averages, a little further away from the 50-day average, moving average on that one, but we are up against this down channel trend line that hasn't been broken since April, and so we need to clear that first, as well as the 50-day, and then if we do see both of those break, then we could expect a bit of a bounce in the Dow Jones Industrial Averages. But just like the other indices, until we see that broken, and since it hasn't broken 50 days since April, I think that the bias has to be to the downside, and then we'll likely hit that and then roll over from there. And then taking a look at the Dow Jones Transportation Index. These are weekly candlesticks, and so for about the last 5 weeks, we've kind of been chopping around sideways on this. And so keep an eye on that to see where the direction is from here until we see a clear break above these last 5 weeks or so of price action, either to the upside or downside. It's looking like some sideways choppy price action in the transports for now. And then we jump over to the Russell 3000 chart. We've been watching this one really closely for quite some time. This up channel line go all the way back to the Great Financial Crisis, and so it's been a very reliable long-term trend line to keep good tabs on. The yellow line is our center channel here, which we broke a while ago. These are weekly candlesticks, so it was about 5 weeks ago where we broke below that line, and now we've been kind of testing up above the center channel line. So we'll need to keep a close eye on that one and see if we can get back above that level. My suspicion is that we probably don't, and that that'll likely act as solid resistance, and that we probably head lower here on the Russell 3000 fairly soon. And then take a look at the Russell 1000, our large caps. A lot of choppy sideways action on this one for about the last 4 or 5 weeks. So we'll have to keep an eye on this one to see if we can see a clear break. For now, it's really just some sideways action. We want to see a clear break above 216 for any kind of large cap rally, or a break below the 204 or 205 level on the Russell 1000 for further sell-off in large caps. And then the small caps are Russell 2000. We have been shopping around at this key support and resistance level at 173.55. Acted as resistance and a local top back in 2018, and then we have been pretty definitively above that up until recently. It did act as support for a little while. We got a bit of a bounce off of that, but now we're just kind of chopping around sideways right around this level. At certain weeks we get above it briefly, then the next week it seems to fall back down, and so there seems to be a lot of indecision in the small caps, a lot of choppy sideways action. And the small caps oftentimes lead the market, and so I think once we see a definitive move in either direction on the Russell 2000, that'll give us an idea as to whether or not there's an opportunity for a bear market bounce if we see a clear break above that 200-week moving average, or if we see some real clear price action below, probably call it about 160, 165 on the IWM. If we head lower from there, then that would be a pretty bearish signal for the markets. And we're taking a look at our growth versus value chart here. Growth has continued to outperform for the most part for multiple weeks now after a pretty significant sell-off in growth versus value. We are above a key ratio support level at 1.53 on this chart, and we are also above the 200-week moving average, which we had fallen below not too long ago. And so if we stay above those levels, then we might continue to see a little bit of outperformance in growth over value. But I think we'll likely see that roll over at some point and continue to the downside in the near term. And then taking a look at our sectors that we track. This is for the last 2 weeks of trading action, trying to get an idea of the last couple of weeks of price action to find some relative strength and relative outperformance in the markets. And in our leaderboard, we're seeing natural gas after a pretty bad sell-off for multiple weeks. We've seen a huge rebound in the natural gas space, up over 27% in the last 2 weeks alone. And so natural gas had a big sell-off, but has regained a lot of that sell-off already and is looking pretty strong right now. And in second place, we got Biotech sitting at about a little over 10% up on the last couple of weeks. Arc Innovation is up over 10% over the last couple of weeks, although it did have a bit of a sell-off this last week. So those numbers would have been even better had we not had the sell-off in this most recent week. We're seeing some relative outperformance out of home builders up 7%, consumer discretionary up 5.1%, and semiconductors up 5% all over the last couple of weeks. And so those are your strongest sectors over the last couple of trading weeks. And then taking a look at some of our weakest sectors, we can see that silver, gold, and gold miners are clearly in the bottom, down anywhere from 5 to almost 8%. Also saw some relative weakness in the energy space, steel, and emerging markets as well. And then taking a look at our oil chart, oil has really seen a bit of a change over the last few weeks. We've seen some downward pressure in the oil prices. We're now closed out on the week below $100 a barrel. That was kind of always a level that I was watching pretty closely, and we are clearly below that now. And it's really kind of hard to say where oil is going from here. I think there's a lot of reasons why oil should go higher. With our global macro environment going on, with a lot of conflicts going on and supply chains being strained, and just the supply-demand imbalance in oil is still kind of a mess. But we are definitely seeing price action tell us otherwise, and prices heading to the downside for the time being. So until we can see I'm probably going to want to see a break above, say, that 107.75 level on U.S. oil to get excited and get kind of bullish on energy trades potentially again. But for now, sitting kind of bearish to neutral on the oil and energy space for the time being. And then take a look at our commodities index, the CRB index. We talked about how we had the center channel. We wanted to see if that was going to hold or break down. 2 weeks ago, it did break down below that level, but regained most of it during that week. But then this week, we saw further downside pressure, and ultimately saw commodities broadly selling off once again. And so the thing that I'm going to be looking for in the commodity space, specifically the CRB index, is we are approaching this 50-week moving average, as well as this down channel line, or uptrend channel line rather. And so that'll be a really key area to look for. So that's probably right around the 262, 264 level, maybe 265. And if we see some real clear price action where it bounces and holds that as support and then moves to the upside from there, that could be a decent entry going long into the commodity space. But if we see a break down below this channel line, as well as the 50-week moving average, which we really haven't been below since about October of 2020, that'll be a pretty strong signal, I think, that the long commodity trade is over for the time being. But we haven't got there yet, so there's been a lot of sell-off in the commodity space over the last 4 or 5 weeks. But we still are with such a strong uptrend that we, even with the selling pressure, we are still technically in a bullish upward long-term trend. And so we want to see if you're bearish and you want to see commodities continue to go down, which arguably would be better for the world right now, we want to see a clear break below that 50-week moving average, and I think that'll be a pretty strong signal. And so I think in the next few weeks we'll get a good idea as to where that's heading from here. And then taking a look at our consumer discretionary versus consumer staples, we talked about the 0.65 ratio line as a really key level. We did hit that, and it acted as support. If we drop below that ratio line, I think that's going to be a pretty strong signal that that's going to be the next downward leg in the market. And so if we do see some price action drop below that 0.65 line, I think that's going to show people are continuing to get more and more defensive. We are at pretty historic levels on this chart. We've only been at the 0.65 ratio line really just a few other times, and most of those times we're in some pretty tough market conditions. So I think that's just telling us that we're certainly living through a tough market condition right now, and likely when we drop below that 0.65 level, which I'm sort of anticipating we will, that'll probably be a signal that the next leg down in the markets are probably happening, but we're holding it as support for now. And then take a look at our all world index minus US. So we're taking a look at global markets with this chart. We did head lower on the week, but a lot of those losses were recovered for the week. And so we'll see if this could be potentially a little bit of a bottom in the global markets with that price action. We'll have to keep a close eye on it going into next week. But looking at it on a relative basis, we've got the emerging markets divided by the SPY. We can see that the global markets relative to the US are still struggling as well. And the interesting development on the high yield corporate bond ETF, we've talked about this one quite a bit, and it's a really good signal as to market health. We're below this 0.7511 level, which is a level we hadn't really broke other than during the COVID crash as well as the Great Financial Crisis. And so there was a lot of concern warranted, I think, when we got below those levels, and even arguably quite a bit before that, but I think that was a pretty extreme reading that we've only seen a few other times. We did actually get back above that level this week, so we're sitting at about 75.50, and that line in the sand's right around 75. And so if we are going to see a bear market rally, I think we would continue to see the high yield corporate bond ETF move higher, or at least stay above that 75 level. And if we do see the HYG drop below that level, then I think that's telling us that this potential bear market bounce is not going to happen. And when we look at it on a relative basis, the corporate bonds divided by the treasury bonds, the IEF, this gives us a good ratio chart to use for some market signals. We talked about anytime we broke down below this 0.73 level, that could be a signal that the markets are going to sell off again. When we did a few weeks ago, that was in fact the case. And then we had a big rally this 2 weeks ago, and then this week we actually dropped below that ratio line a bit, but then recovered. And so as long as we're staying above this trend line here, and it's acting as support, then I think that is a signal that there could be a potential short-term bounce. But if we drop below that level, then I think all bets are off. Taking a look at our gold and silver charts, starting out with gold, we talked about how after we saw some key price levels break below some of the 50-day moving averages, or 50-week moving averages rather, a few weeks back, that it looked like we were potentially heading down to the 200-day or 200-week moving average rather, and it's looking like that's going to be the case. We may hold support at that 157 level, which ultimately might end up being about where the 200-week ultimately settles out at, but I think expecting gold to either approach that 200-week moving average or potentially hold support at 157.20 are going to be key. And if we see it drop below that 200-week moving average, then I think that's a pretty bearish signal for gold broadly. But if we can see it hold that level and bounce, then that could be a decent long-term entry point if you're looking for some gold acquisitions on a longer time horizon. And then silver is actually well below the 200-week moving average already, so silver is actually underperforming gold currently. We're sitting at about $17 an ounce right now, and if we do bounce from here, then hopefully we'll get back up above the 1775 level on silver. But if we don't, then if we continue to head lower, then I'd be looking at about 1550 or so on the silver price for a possible floor and a bounce from there. And then take a look at our DXY, the US dollar index, continues to rip higher. We are at a key support level. We are still above a key support level at 107.68, 69 roughly. And so as long as we're above that, I think we're likely headed higher. If we see the dollar roll over from here and head lower, then that could be a good sign for a potential bear market bounce in stocks. So we'll be keeping a close eye on that. But so far, the dollar just keeps ripping higher and higher, and a higher dollar is generally bearish for stock markets. And then taking a look at our tips divided by IEF, so this is Treasury protected bonds versus traditional bonds. When this is going up and to the right, that's telling us that inflation expectations are rising, and while we did see a pretty clear break and trend off of that recently, it looks like it's found a little bit of support right around the 100-week moving average, and so we'll see if that continues to hold the support, and I think there's a decent chance that we maybe head a little bit higher on this chart, as we're likely going to see some more interest rate hikes based on the most recent CPI reports. And then we're taking a look at those interest rates. The 2% sitting at about 3.12% currently. As long as we're above 2.983, I think the bias has got to be to the upside, but if we do see a break below that 2.983, which was our previous high back in 2019, as long as that's acting as support, I think we're looking for 2.983 or higher. But if that does break and fail and heads lower, then there could be potentially some bond trade setups. At some point, there's been a lot of people talking about looking for that bottom in the bond trade to find that top in rates and kind of ride that as rates essentially roll over. But I'm not quite sure we're there yet. So for me, I need to probably see the 2-year break below 2.8% to get excited about potentially a bond trade. And then taking a look at our 10-year, I really want to see it drop below this line. It's about a 40-year trend line in the 10-year Treasury bond. So we'd want to probably see a drop below, say, 2.7%. And then I'd start to maybe get excited about some potential bond trades, but we're not there yet. And then the 30-year looks like we're closing out the week at about 3.08%, and on the third year we'd probably want to see a drop below that 2.97% if we're going to start getting excited about some potential bond trade, but I'm not sure we're quite there yet. And then taking a look at our yield curve, we did a short video on this not too long ago talking about how we did reinvert and get below the zero line. But not only did we get below the zero line, we dropped significantly below that and all the way down to the negative 22% on this chart here, and that's a pretty significant level, as we've only reached that level a couple of times. The last time was during the financial crisis, where we saw over 50% correction in the markets, and the time previous to that was during the dot-com bust in the early 2000s, and that we also saw 50+% correction in that sell-off as well. And so not good historical company to keep that we're sitting at these levels. I think that's telling us that the sell-off is not done. We likely have quite a bit more pain ahead in the markets, but we did see that it did act as support at that negative 0.22% line, and so maybe that does ultimately act as support. Maybe we see a little bit of a bounce from here, but wouldn't shock me to see it actually go invert even lower from here longer term. And then taking a look at our VIX, we actually have seen some pretty interesting developments in the VIX this week. We have not touched the 200-day moving average since April of this year, and we did just touch that 200-day moving average going into Friday. And so that'll be a really interesting thing to watch going into next week. If we are going to see any kind of a bear market bounce, I would expect the VIX to probably stay below that 25 level, and even better would be if it dropped below that 200-day moving average, because that would be the first time it's done that since April, and that might be a bit of a signal that maybe that we do get a short-term bounce before we head lower. And then taking a look at our put-call ratio, anything above 1 is elevated put buying protection. We did get above that briefly for the week, but ultimately closed the week out at 0.913. So we're in the normal ranges between the 0.5 and 1 ratio on this chart, and so no elevated put buying protection currently in the markets. And we'll go ahead and close it out with a couple of crypto charts for the week. So taking a look at Bitcoin, we are sitting at about 21,200 at the time of this recording, which is on Saturday, and on the 16th. and we are just kind of been chopping around in quite a bit of a range. We had that bit of a sell-off down to the anchored VWAP level, which is right around 18,000, and then from there we've just kind of been chopping around sideways really since June or so. We've had so a period of time where we moved up a bit, then we sold off back down below 20, got back above 20, dropped below 20 not too long ago, and then now we're back above 20. So it's been a lot of real choppy sideways action. It's made it hard to do any really good, successful, consistent trades, because as soon as you get into a trade, because it's starting to look good, then all of a sudden the markets sell off a bit. And so there's been not a lot of great trade setups. We did call out a trade setup on Uniswap, on a inverted head and shoulders that so far has been working out. So that's been a great trade that we've been in. And we're taking a look at keeping a close eye on Ethereum as well. So let's finish it off with that chart here. We did get above the 50-day moving average, but failed off of that so far on this candlestick, which is the candlestick on 7/16. And so if we can see a clear break above that, and ultimately I'd want to probably see Ethereum get above that 1550 level. And 1550 is a key level because it was the all-time high back in 2018. And price has memory in these markets, and so we think that's a really strong support and resistance level. And so if we can see a clear break above the 1550 level, then I'll potentially be looking for an Ethereum trade if we can get above that. I think if we do see a bounce above that, then maybe we could get us as high as the 200-day moving average before selling off again. And then we also have potential resistance at about 21.25. So if we get above the 1550 level on Ethereum, we could be looking at some upside targets of 21.25 or 24.50, which would represent about 35 to 55% of upside potentially. So I'm not in this trade quite yet. We did fail so far on the day where we're not able to hold above that 50-day moving average, and ultimately I don't even want to get into it if it ultimately closes above that, because it could easily just go up to 1550 and then roll over from there. So watching that 1550 level closely, and if we do see some price action close above that level, then we might be looking for an Ethereum trade as long as Bitcoin's holding up above those key levels. Thanks for tuning in this week. Make sure to like and share, and you can download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto, and I'll see you next week.